It's time for the MF Corner right here on the show, and today we put the spotlight on balanced funds. Now, they help your portfolio grow while shielding it from extreme market volatility. Our market expert, Dhirendra Kumar, CEO at Value Research, joins us to talk about two balanced funds that actually look same, but in a sense are very different. Afternoon, Dhirendra. Birla Sun Life 95 and Tata Balanced are both four-star funds that were launched back in 1995. Now, since launch, the Birla Fund has performed better, but if you look at the 5-year, 3-year and 1-year period, it's the Tata Fund that has given better returns to investors. What is the change in strategy that has caused this turnaround?
Birla Sun Life 95 started as Alliance 95, and the early part of this, the initial years were blockbuster, in 1995. That apart, I think, off late Birla Sun Life 95 is managed fairly conservatively. And that, I think, is the deal for the balanced fund investor. Balanced fund investor should not evaluate a balanced fund purely based on return. Balanced fund investors primarily seek, a steadier take on growth, and that is what these funds have been able to deliver. Tata Balanced is a good fund, but it's little more, not as conservative as the Birla Sun Life 95 based on its allocation as well as its equity portfolio focus.
Dhirendra, so which of these two funds would you recommend to investors, and what would be the rationale behind it? As
I was explaining that, what balanced fund investor, who is, generally the kind of investor who like balanced fund or their need is fulfilled, that is seeking great stability, and I think Birla Sun Life 95 does that better.
Okay, Dhirendra, let's also take some viewer queries on the show. The first query is from Kamesh Kumar. He has some matured units of SBI Magnum tax gain, and he's thinking of switching the matured units to SBI Magnum Emerging. Is this an advisable move? He wants to know, Dhirendra.
Yes, it is quite natural for investors to get upset with Magnum tax gain, which was a blockbuster, which was a great fund 5 years back and did slip into mediocrity. And I would say that it is a good large cap fund. It is beginning to do well. Hold on. And also, if you are Magnum Emerging Business is a very aggressive fund. You just might be in for a surprise if we are ahead. If we are expecting a volatile market, or if market goes into some kind of phase of decline, here is a fund which can suffer. Off late, it has done exceedingly well. So if you make a change, beware of the risks.
Dhirendra, our second query today is from Madhur Kalra, and he says that he has an aggressive risk profile and he selected the following funds for SIP investments, and they go as follows. He's got SBI Magnum Business, Reliance Pharma, IDFC Premier Equity as well as ICICI Pru Discovery, and he wants to know if this is a reasonable choice that he's made.
Yeah, I think he has done an excellent job of picking the right funds. But I would suggest him to ignore drop the sector fund, the pharma fund, simply because sector fund, that, pharma funds are doing well and this fund in particular is doing well, but it will have its cyclicality. The other funds, they will be able to navigate through because their portfolio will not be constrained.
Okay, then we've got time to sneak in another query as well today. It's from Manoj Ashar in Mumbai. He wants to know why you've not rated the Birla MNC fund. We discussed about the MNC funds yesterday, but we couldn't take the queries. So he wants to know why have you not rated this fund?
Our rating system actually, requires at least a homogeneous set of funds in a particular category. There are only 2 MNC funds, and it cannot be put into any generic category because the portfolios are constrained by ownership. So that is why MNC funds are not rated. But if we just slot these 2 funds into our large and mid cap category, or our multi cap category where they are very likely to fit in, then I think they are and if they are rated using the same yardstick, I think they will get slotted as this fund will get slotted as a 4-star or certainly a 4-star fund.
Our fourth query today, Dhirendra, is from Thomas Ninan, and he says that assume that he invests in a lump sum, or rather lump sum money in a fund in 2012 with the Sensex at 17,000 levels, and after 5 years, if the Sensex is again back to 17,000, will the NAV in 2017 be the same as in 2012? So he's got a really long-term 5-year perspective in mind.
The very honest answer is that I don't know, but it's very likely. I think, what he's trying to derive some kind of comfort that can he really not make any. I think the way to approach this is markets are unpredictable. Last 5 years have been very difficult. But if you look at, the broad numbers of, about 60% of the funds have been able to beat the benchmark, beat the Sensex over the past 5 years, which has been very difficult. So expect return. Returns will depend on the market, will depend on the kind of fund you have chosen. And if market, if you get unlucky with both, it might get disappointing.